Hey guys, welcome back. Today's video is going to be unscripted. I'm going to go off my slides. We're talking about time-sensitive stuff. We're talking about Alibaba. And the tone's going to be a little different too. I'm going to be a little bit more informal, okay? So we've got a lot to cover. And first, I want to share my grand opinion. And it's that the worst is likely over for China and the BAT companies. I don't think that we are going to revisit those March lows where Alibaba was in the 70 range. Okay, I think those days are past us, and we've been talking about that for several weeks now. Let's talk. All right, we got a lot to talk about. An update on COVID and the impact on the Chinese economy, this emerging shift in sentiment that we're seeing. I want to talk about how this headwind that we still have in the market, high oil prices, how it impacts China and US differently. Then I'll give an update on my analysis on Alibaba based on their latest quarter, and then also provide an update on what we've been doing. And all of this will be high level, so I can give you this information as quickly as possible. I want to recap what happened last quarter. And last quarter, Alibaba did not give a lot of clear guidance on a number of fronts, whether it was retail sales, whether it was competition, the cloud market, or even government policy. There was not a lot of visibility whatsoever. Now, what I picked up from last quarter's earnings transcript was that Daniel Zhang, he said over here, if you can see my mouse, that if the impact of COVID could be lessened, or if there could be stimulus policy from the government put in place to stimulate consumption, those would be positive developments. Yes, and that's exactly what we've seen, and that's why sentiment is rushing back into the market. Last quarter, we didn't get the answers to those questions yet, but we're seeing that now. We can see that the COVID case count has a direct impact on sentiment in China, specifically the consumer names like Alibaba and JD. In fact, advertising companies like Tencent and Baidu, those companies are going to be impacted less sensitively by COVID than Alibaba and JD. So when we were seeing COVID cases peak and we saw COVID cases fall, I made a video in the last several weeks that talked about how the reopening trade was going to happen, and we are seeing that play out as we speak. Now, I want to make it perfectly clear that my strategy and my guidance publicly and in our investment community was that 80 and 90 range was very attractive. Okay, even $100 a share was very attractive. At 120 per share now, it's a little bit late to be chasing. It's a little bit late. So make sure that you're managing your risk correctly and make sure that you're not chasing and FOMOing into the name. So I do want to make a point on the real Chinese economy compared to Chinese stocks. We're seeing Chinese stocks really recover rapidly, but in terms of the real economy, the youth unemployment rate continues to be relatively high. We're seeing young professionals still out of work because of all the job cuts seen in the internet sector, the education sector, and the real estate sector. So in order for this rally to be durable, I would encourage you to definitely follow the economic data in China. In order for the rally to be sustainable, in my opinion, we do need to see the data improve in China. Otherwise, the rally might get ahead of itself. So that's something that you do want to pay attention to. Now, in terms of why I was relatively confident in the BAT companies of China in the last several weeks, the last 2 months, 3 months, is that the valuation, even on a recovery, still looks very attractive. Now, Alibaba today at $120 a share, it's getting closer and closer and closer back to fair value. And so off 50% from the lows, I'm not sure that people should be chasing Alibaba today. However, on a retracement in Alibaba, there will be once again be opportunities. So sentiment is starting to shift, and I think it starts with this major news point here from DD Global and how the cybersecurity probe, this lift-on ban on new users is happening. So as a reminder, what happened last year in July, in 2021? There was a major ban on DD Global. And we can see here back in July 2021, China's cyberspace regulator ordered app stores to remove DD, dealing a major blow to a ride-sharing giant that just days ago pulled off one of the largest US IPO offerings of the past decade. And now that ban is going to be reversed to a certain degree. And because of that, we're starting to see sentiment in terms of headlines materially improve. From Bloomberg, the worst may be over for China stocks with tech probes and insight. We're also seeing headlines such as traders rush to buy China Internet ETF as some say worst is over. And also we're seeing Vice Premier Liu He continuing to voice support for the tech sector, and that combined with their actions is starting to improve sentiment, and that's shown in fund flows, and that's shown in the recovery in stock prices. Now, before I talk about how oil prices might disrupt that dynamic, before I give an update on Alibaba, I just want to give a quick shout out to our sponsor today, FTX US. You may have seen on the news that the crypto industry at large is freezing hiring and doing job cuts. FTX is actually moving in the other direction and not stopping their pace of hiring. In fact, FTX is potentially eyeing M&A deals in the crypto space. Now, according to Barron's, FTX is seeking a license modification from the CFTC to act as both an exchange and a middleman between counterparties and leveraged derivatives trading, handling the collateral and margin requirements in-house when borrowed money is in play. FTX also recently launched stock trading on its app. And on top of stock trading, FTX has a complete crypto and finance app that allows users to buy crypto assets and NFTs with no fees. Dollar cost averaging is a built-in function on the app, which allows users to buy chunks of crypto over time. One of my favorite other parts of the app is that the fees on this exchange are much lower than the other ones out in the market. No minimum fixed fees on transactions. You can use the FTX app to buy your favorite NFTs with no gas fees, and also up to 85% lower fees than other top exchanges. For my friends here on YouTube, FTX is giving all my users who use the code Larry Chung to get free crypto on every trade over $10, but you gotta use my link below to download the FTX app. Just downloading the free app supports my investment research published here on YouTube, and as always, thank you in advance for your support. So with that said, let's get back into the video and let's talk about a major headwind, not just for the stock market, but for consumers in general here in the US and also in China, and that's high oil prices. Now, I do want you to take note that China's reopening phase will add fuel to the global oil demand. In other words, it's my view that China's reopening will potentially add to US inflation. And I want to share with you some data points here. And one of the following data points is that the world consumes about 100 million barrels of oil per day. China represents 16 million barrels a day when their production is back to normal. And because of that, with zero COVID essentially those curbs gone, we're going to see China adding more demand onto the oil markets, especially because the EU is trying to cut off gas from Russia. Now, we are seeing that high oil prices is unfortunately looking like it's here to stay. And I don't think that this chart is very constructive for US stocks or US consumers, and here's why. Number one, high oil prices are a structural drag on US corporate earnings. On top of that, I want to show you the fact that even though gas prices are rising in China rapidly in an uncomfortable way, it will impact Chinese consumers somewhat less. Here's the data. Chinese consumers spend about 1.6% of their income on gas. That's relatively reasonable. Whereas US consumers, we spend about 3.1% of our income on gas. And this data poll was actually launched back in April. And given how much gas has gone up since April, this percentage for the US consumers and Chinese consumers has also most likely gone up. So this means, because of the percentages I just showed you, high gas prices is a much bigger problem for US consumers and companies. Now, the car ownership in China looks like this. This is 2019, 2020 data, but if we extrapolate that to 2021 and 2022, I don't believe the percentages will materially change by all that much. If we look at this chart, if we look at urban households, we're looking at about 45% of urban households owning cars in China. And nationwide, it's about 37%. And in rural households, it's only about 26%. Now, in contrast, though, in the US, we've got 90% plus households owning access to a vehicle. So when we combine these statistics together, look at this again. We've got Chinese consumers spending 1.6% of their income on gas, and we have US consumers spending about 3.1% of their income on gas, And then we have a lower percentage of car ownership in China compared to a high car ownership percentage in the US. That gives me the opinion that high oil prices are a much bigger drag on the S&P 500 than on the KWEB Internet ETF in China. And that's why even at $120 a barrel for oil, we're not seeing that impact Chinese tech stocks as much. Now, yes, you can say it's macro policy, and you can also say it's improving technicals and improving fundamentals. All that definitely are factors. However, high oil prices don't impact the Chinese economy as severely as the US economy. That's something that I haven't seen being discussed in media outlets, but that's something that I want you to take away from this video. So if we look at oil prices and we look at the fact that oil prices are now north of $120 a barrel, around $120 a barrel. So, this is the wrong chart. $122 a barrel. As oil prices continue to go higher, I struggle to see how the S&P 500 can continue to move much higher from here so long as oil is this elevated. So that's something to keep an eye out for. Now, I want to talk about Alibaba's latest quarter, just really briefly. I do a really detailed overview inside my investment community. I want to give a general overview here just so that you understand the big picture and you know how to think about Alibaba in the context of today's market. There were some major questions from sell-side analysts in the latest quarter, and these are some observations that I think that are important to follow. So the questions include, are consumers showing differences in spending patterns? What are Alibaba's thoughts on government regulation and policy, and any commentary on cost control? In other words, their investment cycle. What are they doing to protect profitability? And this time we saw a lot more clarity, which I thought was constructive. So the first question about whether there are changes in consumer consumption was answered like this: that consumers they're spending more money on essential goods and less money on non-essential goods. However, in terms of the volume compared to previous quarters, the volume continues to be very healthy. And because volume continues to be very healthy, Alibaba's business results were relatively healthy this past quarter. Now, on top of consumer patterns, Alibaba also is now focusing more on cost control, and this is very important. This is from Toby Xu from Alibaba, answering Jerry Liu, one of the sell-side analysts. You can see here that I think for the group as a whole, it's very clear that our strategy in the next few quarters or year as a whole is going to focus on cost optimization and cost control, and that will involve a couple things. First of all, for the parts of the business that aren't generating long-term value, we'll find ways to make them more efficient or scale them down with consolidation. If we translate that into plain English, that means that Alibaba is slowing down the investment cycle. They're slowing hiring to reduce the cost structure to improve EPS. And that means not only is the government in China becoming more stock market friendly, the corporate strategy is becoming more investor friendly as well. Now, when asked about the government policy, Daniel Zhang, here's how he responded. He responded by saying that he believes that Chinese leaders have shared a very clear message, that they want the platform economy to play an important role in the economic development and the healthy development of the platform economy. And Alibaba is playing a crucial role in that part. And he also responded by saying that the government has released important policy signals on its commitment to stabilize the economy and the job market in response to COVID impacts. And that's precisely what the buy side wants to see in order to have confidence again to invest in the Chinese tech sector. The macro policy in China is very, very important and sensitive to how the buy side is thinking about the BAT companies of China. So in terms of Alibaba's latest quarter, we're seeing their annual active customers, their annual active consumers globally reach 1 billion users in China, and that's very healthy. And they're continuing to see their international numbers grow as well. But the buy side isn't really focused on small details as it relates to Alibaba's business. They're focused on several key aspects. Is China reopening due to zero COVID fading away? Is the monetary policy going to strengthen? Is the commitment from the government to strengthen the economy going to be durable? Those are continuing to be the frameworks that I'm leveraging in order to understand this sector. Yes, the cloud segment is a very important part of Alibaba's future. However, this segment will take time for Alibaba to really play out. So for that reason, in the short to intermediate term, it's macro that's driving the BAT companies of China. I discussed this in my recent newsletter. You can check it out if you're on my email. I talked about this about a week ago, and I said, look, I understand the intense pessimism that my public audience holds on China. And I said this very clearly. You see this bar here? However, I continue to believe, the diverging monetary policy goals between China and the US will have onshore China investors start reconsidering their fund mandates allocation. This is a long-term strategy. China's not for short-term investors. And many people think that all Chinese internet investors are completely underwater. They have no profitable positions, but that's a flawed assumption, okay? That's a flawed assumption. We talked about how we added positions in Alibaba KWEB JD on May 20th when Alibaba was still around that $85, $87 a share. And this has been investment strategy that I've been sharing inside our community, that I significantly added onto Alibaba at 85 and 90 in late April because I missed the big sell-off in March to accumulate heavily, but I wasn't missing this chance again. Now, that said, the Russia-Ukraine war continues to be significant developments to watch, so make sure you're on top of all developments going on in Russia, Ukraine, very important. Now, if you enjoyed this, but you don't have the time to follow all this and want further guidance, become a supportive member and let me be your strategist inside our welcoming community. In the first half of May, we reiterated Chinese internet. And in the second half of May, I reiterated Chinese internet again, providing additional clarity on data points that we should look forward to. And in late May, I talked about how it was an opportunity to add on to this sector because the divergence between US and China macro is becoming more and more clear. We're seeing QT in the US, whereas there's easing in China. You have to put two and two together. Now, of course, if the S&P 500 and the NASDAQ falls significantly, Alibaba, Tencent, they won't be spared from that. But as long as there's consolidation in US markets, China is still relatively attractive. You can see that in May 2022, Chinese internet was the only sector really that I had a buy rating on in the short term, and in the long term view, I had a strong buy rating on it along with semiconductors, which we know in May did relatively well. And for June, we can see that for the most part, the S&P 500 has done nothing in June. The NASDAQ has done nothing in June. And China has been one of the few sectors that I've put a buy rating on in the short term, and also the long term. I put everything else on hold because of that really strong rally that we saw across US tech in late May. So, this chart isn't updated, of course, for today, but we've had a good month for Alibaba. So congratulations again if you hold it or if you were able to buy it around the 80, 90 range. I'm really happy for you, but please manage your risk and please do not FOMO into this name. I'm here to provide you awesome research and guidance, but make sure that you are following the news, following the research closely. And if you need help, I'm here for you. I'm determined to be the best Chinese internet equity research analyst on YouTube. So join me in this mission. Actually here, I need to delete that. And I'm gonna say it one more time. I am determined to be the best Chinese internet equity research analyst on YouTube. Join me in this mission. There's more volatility ahead, but I will do everything I can to provide my best strategy and research for our community. And the last thing that I want to say is if EV names like NIO is interesting to you, let me know in the YouTube comment section if you want me to cover this name in the future. I haven't talked about NIO very much on my channel, but I hold NIO. I advocated for NIO at $16 a share. And I've been discussing this inside our investment community, and obviously that's done very, very well. But if NIO is something that's interesting to you or other EV names are interesting to you, let me know in the comment section. And in the future, I can potentially discuss more names from China. With that said, congratulations again if you hold Alibaba, if you were able to buy in the 80-90 range. I'm really happy for you. I genuinely am. And look, from here, there's going to be a little bit more choppiness ahead. Alibaba's up 50% in literally 45 days. We can't expect the name to run up in a linear fashion. There will be more choppiness ahead, and I'll have more coverage ahead. Much love, guys, and I will see you in my next video. Share this with friends and family. Hit that like button, and I will see you guys in my next video.